Hey YouTube, I'm Jimmy. In this video, I'm going to walk through creating a stock portfolio for a beginning investor, somebody who's in their 20s or 30s and is just getting started in the stock market. I'm going to focus mostly on stocks, although I am going to bring out where bonds or alternative investments can come into play. So I believe the cleanest and simplest way to build a portfolio for most investors is to use exchange traded funds, or ETFs for short. And if you're confident enough to pick individual stocks, well, I'll let you know where I would throw that into the portfolio. For me, that's a good idea if what you're trying to do is improve your total return or improve dividends or something along those lines. Okay, so let's get started. My first holding is almost always a large cap core holding. I like SPY, which is the Spider S&P 500 ETF. They only charge 9.5 basis points for a fee, and just so we're all on the same page, if a company were to charge 1% fee, well, that would be 100 basis points. So 50 basis points is 0.5%. So 1 basis point equals 1/100th of a percent. So SPY charges 9.5 basis points. So SPY, as you may have guessed, owns the 500 companies that are in the S&P 500. Now, this is good. I like this because this gives us instant diversification to the largest companies in the US stock market. The largest holdings are companies like Microsoft, Apple, Amazon, Berkshire Hathaway. They have Johnson & Johnson's in there, ExxonMobil, JP Morgan Chase. So basically, it's the biggest companies in the US. Now, I'm going to save the weightings, how much I would assign to each individual ETF until the end, because I think we have some flexibility as to different things we could do to make the portfolio better. Okay, so now that we own SPY, well, now we have our large cap companies, 500 of them actually. But historically, smaller companies typically grow at a faster rate than larger companies. Since it's easier to grow, let's say, a $5 billion company than it is to grow a $500 billion company. So now we should go after some smaller companies. A popular, broadly diversified index that has many small companies in it is the Russell 2000 index. And the cheapest Russell 2000 ETF that I could find is the Vanguard Russell 2000 ETF, ticker symbol VTWO, and they charge just 15 basis points for their fee. This ETF has companies like HubSpot, Planet Fitness, Five Below, and Etsy. So right now, I think we're right in line with where we want to be as far as diversification. With just 2 ETFs, we have over 2,500 holdings, and that's plenty diversified in my mind. But I'd like to add a little more growth to the portfolio. I like mid-cap companies because I think mid-cap companies are a great place to pick up some real growth, and a mid-cap company has enough size to at least be a real player in their industry, enough stability because they're large enough, but they still have some room for growth. So I really like going in the mid-cap space as well. So to target the mid-cap space, I like the iShares S&P 400 MidCap Growth ETF, ticker symbol IJK. IJK owns companies like Domino's Pizza, Six Flags, Transocean, or the Boston Beer Company. They own Sam Adams. Now, these companies I think are in a good position because they have a decent amount of growth available to them, but they still have some size behind them. So now we have a large cap, a mid cap, and a small cap ETF. And I like these 3 ETFs as our core holdings, but I think we could do a bit more to diversify. So company size isn't the only way to diversify. We could diversify by growth rate, value characteristics, geography, volatility, and the list goes on and on. So I think it would be smart for us to add an emerging markets ETF to this, since in theory, this will give us some diversification in both a geography sense as well as some growth characteristics. One ETF I like is called the Invesco Emerging Markets ETF, ticker symbol PXH. PXH has a fee of 49 basis points. This is one of the highest ones, but it's somewhat of a specialty ETF, so I get it. Now, I like this because it's a diversified ETF that invests in markets like China, Taiwan, Brazil, Russia, India, and so on. They are well exposed to many of the emerging markets. Now, for me, I'm happy with these companies as our core holdings. Now, it would actually make a lot of sense to add a bond ETF here or bond mutual fund, but since this video is designed for building a stock portfolio, I'm going to leave it off. But if you wanted to add the bond component to this, it would make a lot of sense. Okay, now let's look at some percentages. If we wanted to stop right here and we were going to try to build our portfolio with just these holdings, I think that would be smart to do about 40% of SPY, 30% mid-cap growth, 15% of both small cap and emerging market funds. Now, if we stopped right here, I'd be perfectly happy because we'd be well diversified, we'd have a solid stock portfolio, and overall, I would expect our performance to be about in line with US markets with a touch of some emerging markets. But what if we wanted more? So now, if we wanted more growth or more dividends or more value or more risk or less risk or whatever it might be, the adjustment to this portfolio is rather simple. Imagine we took off 5% from each of these holdings, and what we're left with is 20% for us to work with. So here's some ideas that I would have if we wanted to make some adjustments to this. One first thought is that these are all equity holdings. These are all stock holdings, but it might make sense to add some real estate holdings. So I would look at something like Vanguard's real estate ETF, ticker symbol VNQ. VNQ they charge 12 basis points, and they have a dividend yield of almost 5%. So if dividends are something that you like, well, this could be a good diversifier because it's in real estate, but it also adds to the dividend story. Another possibility would be to go down the commodity road. An ETF like PowerShares Commodity ETF, ticker symbol DBC. Well, this ETF invests in commodities futures. So if we believe that the price of commodities is going to move higher, this could be a good choice for us. Now, of course, we could combine these two into, let's say, two 10% positions to our portfolio. Then we would have a bunch of different stock investments, well diversified, and some commodities and some real estate. That's a pretty solid portfolio. But for me, what I like to do is something called a satellite portfolio. And I would take our 4 main holdings and we'll call those our core holdings. They end up being in the middle. And then what we do is we take the other 20% outside of our 80% core holdings and we diversify that into individual companies. If you feel so inclined, if you feel confident enough to pick individual names, well, I would use these satellite positions to go around the portfolio to try to get whatever after. Maybe it's more dividends or more growth or better long-term capital gains. I think that those surrounding holdings, the satellite holdings, are the best way to do it. So if this were my main portfolio, well, what I would do is I'm more of a long-term investor, so I would be targeting improved returns, trying to beat the S&P 500. Now, the way I would do it is I would pick 4 additional holdings to go around our core holdings of 80%. So each of them would end up being about 5% per position. Now, if you haven't seen, if you're new to this channel, well, we've been doing a series called the Dow 30 analysis, where we're analyzing all 30 companies in the Dow Jones Industrial Average. You can see a link to all those videos in the description below. Well, from the research we've done so far, I really like Microsoft. I like Chevron. They look good. I like Disney. I like where they're going. Home Depot looks pretty good. I like AT&T. They're not in the Dow 30, but we recently completed an analysis of that, and I like the way they look, and I believe that they have a solid dividend. But I would love to recap all of the analysis that we've done for those, and we're going to get to that eventually when we build those portfolios, but those are a more advanced portfolio. This is designed to be a simpler portfolio for a beginning investor. And for me, I believe that this is a good way for a beginning investor to build a portfolio. Have a core set of holdings that keeps up broadly with the market, and it's diversified and has enough positions that you don't have to worry too much about it. If you held just our core holdings, well, you're likely to perform as the market did. But if you wanted more, let's say, dividends, well, I like a company like AT&T. And if it's a small enough position in one of the satellite positions, it's likely not to hurt you too much if you have a couple of them. I would then throw in companies like Disney or Microsoft because I think that they have a good amount of stability and some growth prospects based on some things that they've been doing lately. But what do you think? What companies would you add if we wanted to get better performance than the market with our satellite holdings? And then actually one final point is that if you are a beginning investor and you're trying to pick your core holdings, I think it's key to try to keep your fees low, stay as diversified as possible, and do as much research as you can. The advantage of doing a satellite portfolio like this is that essentially you get to play with the satellite positions, which is great from a learning standpoint, but also you have your core holdings that sort of anchor you to do what the market does, which I think is a great way to not be too concerned with the overall performance, because it's unlikely that the market will go down and stay down indefinitely. The market has always recovered. Let me know what you think in the comments below. And if you haven't done so already, hit the subscribe button. Don't forget to hit the thumbs up. So thank you very much for sticking with me all the way into the video. I appreciate it, and I'll see you in the next video. Thanks.